All right, everybody. Good morning. My name is Bob Adams. I am the Small Business Liaison with Caltrans District 10. I want to thank you all for being here today. And we have a great workshop lined up for you. And I just want to, if you turn everything over, or first of all, I want to say thank you to my cohorts there in District 5 with Jessica Biro, Small Business Liaison, for all of her help. I'd also like to thank Lorena Ramos, who is going to be facilitating this from District 6 in Fresno, and also District 9 in Bishop, and Jessica, and for all of their assistance in making this happen. So without any further ado, let's go ahead and get started this morning, and I'll turn everything over to Lorena Ramos from District 6.
Thank you, Bob, and good morning, everyone. Thank you for taking the time to join us today for a webinar on surety bonding. Today's presentation features Heis Surety with a guest presentation by Teichert Construction. Again, my name is Lorena Ramos, and I'm the Small Business Liaison for Caltrans District 6. Before we start, I would like to inform all participants that you will be muted for the duration of the webinar. If you have questions, please submit them via the chat feature directly to me, Lorena Ramos. Look for my name on the drop-down menu. Your questions will be answered during one of the Q&A sessions in this presentation. If at the end of the webinar you feel your question wasn't answered, please email one of our presenters. I will share their emails in a moment in the chat box. I also want to share that this webinar is being recorded and will be placed on the District 5 YouTube page by next month. We will share the link to the video with today's participants via email. Okay, now I'll get started with introducing our speakers. I would like to introduce our first speaker from Heis Surety and Insurance Services, Tracey Lawrence. Tracey is the president of Heis Surety and Insurance Services in Riverside, California. She is a professional with 25 years of experience meeting the bonding needs of businesses that participate or want to participate in government contracting. She has been actively involved in all aspects of the surety business, and she's held underwriting positions with 2 of the 3 largest surety companies in America. In 2014, Tracey formed Lawrence Consulting Solutions, a small business that provides DBE support services, creates bonding assistance program solutions, and conducts surety bond training for contract administrators, contractors, and the estimating staff of construction firms. Tracey, the floor is yours.
Good morning, everyone. I am so glad that you are here today. I am very excited about having this opportunity to talk to you about bonding. I've been doing it a long time. I love it. I know the written rules of the business and the unwritten rules of the business. My goal for today is to give you some information that will be tangible, that you can use to get you thinking about what you can do to improve your bonding program and to get you on the path to doing some work for Caltrans. So let's get started. I'm ready to work, but I need bonding. This presentation is brought to you by Caltrans Districts 5, 6, 9, and 10, and I am Tracey Lawrence of Heis Surety and Insurance. We are focused on unlocking new revenue streams. So, right off the bat, why does bonding even matter? What's the big deal, and why does it matter for small businesses? Having a bond program is your key to the government contracting construction revenue stream. With bonding, you're going to have access to opportunities of sizes above thresholds with Caltrans and with other government entities. If you don't have bonding, you won't have the key to that revenue stream. Bonding actually positions you and your business to bid as prime contractors. Yes, there are some really great small to mid-sized opportunities out there set aside for small businesses, but you're going to need bonding. A contractor or business owner who masters, that's a strong word, right? Who masters his or her surety program can manage their business more effectively than a traditional contractor. Now, that may sound a little harsh, but here's some insight to go with that. When you are in the world of bonded work, the bond process itself is going to impact how you make business decisions. It's going to change how you manage your business. It's going to change how you handle your taxes and your financial reporting, and it's going to make you particularly savvy. Bonding opens doors to new client opportunities. It reveals professional development possibilities, not just for you, but for your business, for your team as well. There's that word again, right? A mastered surety profile does more than deliver a desirable lifestyle. We all like a desirable lifestyle, right? And being in the construction business gives us an opportunity to have that, that lifestyle that we're after. But when you are a bonded small business and you are actively in the government construction arena, you have a real opportunity to create economic impact. Yeah, you can create economic impact. All of us on this webinar today, we are part of the economic recovery. We got this, right? Of course we do. There is a major difference between bonding assistance and surety strategy. For us today, we're going to move in the direction of surety strategy. Okay, there's a way. In the bond business, there's a way that things go. Just like you have a process when you are evaluating, do I pursue this opportunity or don't I? Or you have a process for, we need to mobilize because we have the NTP. This is what we're going to do. I'm going to give you the introduction to how things kind of flow in the bond business and at an underwriter's desk. And remember, an underwriter is a decision maker. In my prior job, I was the decision maker as to yes, I'd write the bond, or no, I would not write the bond. Okay? Bonds are required on public works projects, and it's by law. The federal law that makes bonds required is called the Miller Act, right? So if you had hopes that one day bonds would just go away, that's probably not going to happen because it would require the law to just go away, right? So if it's not going to go away, you might as well get really good at it. We're going to master it, right? The Little Miller Acts are the state versions, county, city, school district versions of the Miller Act that they've taken and they've made it appropriate for their area. They've tweaked it, they've adjusted thresholds, and then my industry calls all of those laws at that level, we call those the Little Miller Act. Getting bonded is not like buying insurance. Oh, it's nothing like buying insurance. The very next bullet gives you a lot of insight as to why it's not like buying insurance. The contractor and the project itself, the contract that you want to bond itself, both pieces have to qualify for bonding. The qualification process is much more like applying for a loan with a bank than it is getting a quote for like your commercial auto policy or getting a quote for your workers' comp. It's not like that at all. It is going to require you to submit paperwork, be transparent, be willing to disclose business and personal information. And as much as you would think that being a great contractor should be the qualifier for whether or not you get a bond, that's not quite how it really works at an underwriter's desk. Being a great contractor, doing great work, is actually the floor. Every bonded contractor is supposed to be a great builder, you know. Be prepared to disclose business information and personal information. For those of you that are right now thinking, what? You want personal information too? Yeah, that's exactly how the process works. But the process isn't after you in particular. It's the same for every entity that's trying to get bonded, okay? I will tell you that transparency is required, right? Don't think that you can not be transparent and that the underwriter won't find it. Yeah, the underwriter will find it. Underwriters have tremendous access to information, and we like Google too, right? Indemnification is required. Now, indemnification, hold on, because if you aren't bonded today, this one might knock your socks off. Indemnification says, if I ask a bonding company to support my pursuit of revenue, I will pay the bonding company back if I cause a bond claim. I will pay the bonding company back if I cause a bond claim, right? This is not like insurance where you submit a claim and then the claim adjuster takes care of you and your loss and possibly your client's loss. No. A bond claim actually takes care of the government entity and the taxpayers, and then you get the bill because you're the one that was supposed to meet the obligation. We're talking personal signatures, corporate signatures, spousal signatures, quite possibly related entity signatures, and trust signatures. Indemnification is a major tenet of the bonding process. Without a signed indemnification agreement on file and accepted by the bonding company, there are no bonds. That's right, zero, okay? And the last one is your surety agent. If your surety agent is just somebody you're talking to when you need a bond, you got to take your relationship to the next level because your surety agent should become one of your trusted business advisors. He or she has to be someone that you can share really great news with and celebrate, or not so good news and strategize, okay? Bonds protect your client and the whole of us as taxpayers. Bonds do not protect you or your small business. So, bond pre-qualification. Yeah, Ms. Bond Lady, I heard you say that I have to qualify and the project has to qualify. You said it's like applying for a bank loan. Okay, yeah, that's what I said. So what is the basic rule for how to qualify? I am so glad you guys asked that question. Bond pre-qualification. Decisions to bond contractors are based on favorable assessments of a contractor's character, capacity, and capital. Character, capacity, and capital. We call those the 3 C's of surety. Now, I have this fabulous table with all of these items giving you examples of what an underwriter is looking for and considering in each of the 3 C's. I'm not going to go through the entire table, but I am going to take a few items out of each list. If you look at character, the very first one is, what is your business's reputation in the construction industry? What would job owners say about you if the bonding company called and asked for a reference? What would trade contractors say about you If you're a general contractor, what would subcontractors say about you? What would architects and designers that you work with say about you? If they were to Google you, what's there to see? Character also deals with credit, your personal credit profiles of the owners, all owners of at least 10% or more, and what does your business credit file say about you? Capacity. Capacity is tell us about what type of work you've done before. What's your scope? What size contracts have you successfully completed? How long ago? How recent? Where? Where did you do that work? We're going to be talking about what type of equipment you have. And depending on what your scope is, heavy highway, excavating underground utilities, equipment's going to be a big deal. Or at least access to equipment is going to be a big deal. Okay? And some of the other scopes, equipment, not so much so. So if you think about it, the underwriter's like, okay, what do they have already that can help them actually execute the work? They're going to be looking at personnel. And these days, labor is getting to be a big issue. Okay? It's something that everyone's concerned. How are your relationships with your labor? How is everybody doing right now in the current environment? Do you have ways to keep people safe? The capacity in that area, do you have who you need to actually deliver on time, on budget, safely? And then capital, now you know what capital is. If you guys weren't on mute, I would be expecting everybody to be sending me a note or telling me, yeah, it's about money. It is about money. It's about working capital. Do you have the money you need to finance a project from NTP to first draw? Can you finance that project plus everything else that you have in your backlog? Working capital and net worth are both balance sheet items. For those of you that are like finances and numbers, you're like, balance sheet, that's an interesting deal. Yeah, that is a very interesting feature that goes with the surety bonding process. If you compare it to, say, banking likes profit and loss better, right? They want to know that you have revenue coming in, that you're paying all your bills, and that you still are having some left over. Bonding companies are like, we expect you to have revenue coming in because we're supporting you in that regard. But once you have that profit, once you have profitability, what are you doing with the profit, right? Profits on profit and loss flow into the balance sheet, increasing your net worth. Working capital and net worth have established ratios for how to have bonding capacity. If you have any questions, now's a great time to take a break. So I'm going to let Ms. Lorena check the chat and see if I can answer any questions. Ms. Lorena?
Yes, Tracy, we do have a question. Here it is. So we are often asked, what is the maximum bond amount we qualify for? How do we know this without going through formal bond request process and don't have a job awarded yet?
Oh my goodness. This person is going all in. I love this question. Thank you, Ms. Lorena. Okay, so there are a couple things that you can do to self-assess. That's what I call this process. The first thing I'm going to give you is working capital to bonding capacity. The formula for working capital is current assets off your balance sheet minus current liabilities off your balance sheet equals some number X. So for this conversation, if you have $100,000 in current assets and you have $50,000 in current liabilities, you have $50,000 left for working capital. If there are no adjustments to that working capital, the general rule is $1 of working capital can support $10 of bonding. 50,000 times 10 is 500,000. Now, that's the general rule that works like all over my industry. Depending on your particular scope and your bonding company, it can be more or less. For example, the further down you are in a project, right, then the more working capital you need. So instead of 1 to 10, it may be some number like 1 to 8 or 1 to 5. If you are the general contractor and you have bonded subcontractors, it could be 1 to 15 or 1 to 20. Another tool that you can use is adjusted net worth. $1 of adjusted net worth. That's profits left in the company over time. $1 of net worth supports $10 of bonding. Net worth comes straight off your balance sheet. There's no calculation for it. There are some adjustments, right? So if your net worth includes loans to employees or loans to stockholders, those kinds of things come out because they're not true net worth. Goodwill kind of sits on the side as well, but what's left after adjustments is your net worth. And then the only other thing I'm going to add, and then I'm going to keep going, is your maximum bond capacity, your maximum single bond capacity is governed by your past experience. Okay? This is such a powerful concept. So even if the numbers say that you qualify for $500,000, but the largest job you've ever done is $200,000, you're going to have a tough time actually getting a $500,000 bond, because right now in the marketplace, the general rule is 1.5 to 2 times of the largest job you've ever completed. Okay? If you have any more questions, please keep sending them to the chat. Ms. Lorena, I will check in with you at the next break. Is there anyone else that I need to take care of before we keep going?
Tracey, there's 2 questions. One is really quick, and I can answer that. And they're asking if participants will get a copy of the slides or the presentation. Just a reminder, the webinar is being recorded, so we will be sharing this link with participants. So you will have access to the video and can watch it anytime you need. The only thing we ask, if you're interested in the link, you can send me your email, your name and your email directly to me in the chat box. There is one more question, Tracey. Do you want to take it now, or do we want to wait for the next Q&A?
You go ahead, give it to me now.
Okay. So the question is, if we're a new firm with few resources, can we enter into a joint venture or mentor-protege agreement with a larger firm and use their bonding, insurance, et cetera?
The short answer to that is yes. Okay? There's a much longer answer to that. Just because you're new with limited resources doesn't necessarily mean that you can't be bonded. It may mean you can't be bonded at the level you'd like to be, but if the personal credit of the owners of the new entity is clean, okay? Clean credit. If your license check is clean, if your resumes say that you actually can do construction, you're good at it, right? From prior employment, right? It's very possible you can get a credit-based bond approval. Now, that's not going to help you with any working capital issues that you may have, but you can at least put your foot in the water to see how much you can get bonded for without your joint venture partner. And then, here's Tracey's hot tip for the day. Once you at least have some bonding, you get to say to your prospective joint venture partner, I am at least bonded to some number X. It should help you with your negotiations. Okay, Ms. Lorena, I think I need to keep going. All right.
Yes, go ahead. Thank you.
Thank you. Thank you, everyone. All right. So we know what bonding companies are looking for. They want good character. They want us to have capacity to actually do the work, right? People, equipment, systems. They want us to have the money to fund the work. We're ready. It's time to apply. This is the long version of the application. If you don't have all of these items right now, that is okay. but this is the direction you want to take your bond program. You remember that word I use, master? That's a big difference from calling someone up and just saying, hey, I need a bond, okay? The difference between calling someone up and saying, hey, bond lady, I need a bond, versus, hey, bond lady, I'm trying to master my bond program. This caller just wants the bond need met. This other caller is trying to control outcomes. No surprises, no needing to check in like the question was asked earlier. You already know. So these are the things that you're going to have a complete submission. You're going to have a completed contractor questionnaire. That's just fancy for an application. And then you're going to have CPA reviewed financial statement. CPA reviewed financial statement prepared on an accrual and percentage of completion basis. That's a mouthful. But if you don't have a CPA right now, if you're not doing accrual right now, if you're not doing percentage of completion basis right now, when you get off this webinar, you now have a goal for where you're going to take your business so that you can benefit in your bond program. You're going to need an interim financial statement. That one can be done internally. That's your balance sheet, your profit and loss, agings of receivables and payables, a WIP, and verification of cash. Current personal financial statements on every owner over 10% are going to be required. Okay? Bank line letter, if you already have a line of credit with your bank, which is a very good thing. If you don't have a bank line with your bank, a bank reference letter will suffice. But I'm going to encourage you, the goal, you want to get a bank line. Underwriters love that stuff. Current insurance certificate, they want to make sure that you have the coverage you need so that you can stay in business and you can satisfy your customers. A current work in progress schedule. I can talk for hours about a work in progress schedule. It is a fabulous underwriting tool for bonding companies, but a fabulous management tool for you. If you are not already doing work in progress schedules on a regular basis, I encourage you to start using work in progress schedules today. If you've never used one, start doing one like maybe once every 6 months or once every quarter. Ideally, you want to get to the point where you're doing them at least once a month. I can tell you, some of the biggest construction companies in the nation, they have the ability to manage their work in progress every 24 hours. Woo! Can you imagine that system that they have behind that? Resumes of owners and key staff and reference letters. When you are applying for bonding, it is not the time to be modest. It is not the time not to brag. Brag. Yeah. Tell them about all of the great things that you've done, you've accomplished. Tell them about all the fabulous members of your staff, your team. Talk about the projects you've done. Talk about the things that you want to do, right? Your goal for the application process is to engage, truly engage with the underwriter, right? When you send your application over, or your surety agent sends your application over, you got to remember, the underwriter is a real person. She's sitting there at her desk, or he, right? And they're doing something else. They are working on something else. And then your submission shows up. And it's impressive. You see that A+ on there? It's impressive. All of a sudden, you have placed the demand on that person's time and on that bonding company's resources. Well, while you have their attention, give them something to really read about. Give them something to really be impressed by. You know your business, and you should make sure that your story is amazing. Got to complete the paperwork, though. You know, it's tempting to assign paperwork to someone else. But I'm going to encourage all owners to do the paperwork themselves. Nobody knows your business better than you. Nobody knows your story better than you. You want to complete the contractor's questionnaire. Be thorough. You want to gather the requested information. That's that whole list that we just looked at, right? Or as much of it as possible. You want to review all information for accuracy and thoroughness. If you haven't actually looked at your financial statement yourself and you just press the button and had somebody print it for you, that's not the time to send it, okay? You want to print it out and take a few minutes to read through it, look at it, ask yourself, is this financial statement actually saying what I've been living for the last 12 months, right? Add details for clarity. Anything in your financial statement or anything in your questionnaire that might not be glowing, stop right there and go ahead and put some clarification or explanation. For example, the questionnaire may say, have you ever been terminated from a project? Of course, they want the answer to be no. But if the answer is yes, you want to explain the circumstances. And if you have learned from that experience, just be honest. It was rough. I was afraid. It was a terrible experience. However, we persevered. We made these changes. We did those kinds of things necessary, and that problem we won't have again, right? So you want to add details. Whatever the details are necessary, keep in mind what your goal is. Your goal is to engage with the underwriter so that they believe in you and your company. Submit your paperwork to your surety agent. You only get one time to make a great first impression. If you're on this webinar, I'm predicting that you work it. Work your first time like your boss. Once you submit it, you got to be on standby. Be prepared to ask questions. Underwriters in this business, we love construction contractors. But real life, we don't build anything, right? We have tons of questions, lots and lots of questions. What we're looking for is a construction contractor that has lots and lots of answers. Okay? So now we've applied for bonding. We have sent it in, and we've gotten that email back. Our agent says, congratulations, you have been approved for bonding. Your bond program is this. Well, it's time to get moving. Yeah, I said time to get moving. The first thing you want to do once you have a bond program is you want to put that bond program to work. You want to put it to work immediately. Now, the things I am talking about on this slide, this entire slide is about surety strategy, okay? Not just getting a bond, but this is about positioning your business to actually maximize what it can do from a surety perspective. The more bonding you have, the more government construction revenue you can pursue, right? And these types of behaviors on this slide get you on the path, okay? Put your bond program to work immediately. If you're thinking, okay, bond lady, I know you're saying that just because you want to write a bond. No, you're wrong. That's not why I'm saying that. I'm saying it because when you place that demand on that underwriter by sending your submission and all of your fancy paperwork, you were on their mind at that moment, and it was favorable, right? Don't miss the moment. Don't wait weeks and weeks and months and then come back and ask for your first bond request. Hey, he or she was already in your corner. They were already loving your business. So it's a great time to ask for a bond. Find a project to bid, right? If you have been submitted a proposal and now you are going to need the performance and payment bond, submit the request. use the bonding program that you have, even if it's not what you want, okay? But make plans to adjust you and your business, to adjust you and your business so you can qualify for what you want. If you're wondering what adjustments to make, go back to the slide with the 3 C's. If you can make any of those increase, right, then you are making adjustments so you can qualify for what you want. Start developing a success record with your underwriter and your surety now. Make them believe. I have to tell you, bonding is not a quickie deal. To truly master bonding, you got to be in the game, playing diligently, being strategic for 3 to 5 years. Yep, 3 to 5 years. But don't get disheartened, right? Don't be like, oh, that takes so long, gee whiz. It's really not that bad. You start today, and then you start to manage those 3 C's, increase and leave profits in the company, increase your expertise. You're going to find that 5 years from now, you're going to have an excellent surety relationship. Your bonding company and underwriter are going to believe in you, and your company is going to be thriving. You're going to be creating jobs. You're going to be doing amazing things. On the way, if an opportunity to have a bond waived presents itself, because let's say you're talking to a general contractor, because we already know waiving bonds in government that's not the law, right? So when I say bond waivers, I'm talking when you're working with other contractors. Then you have to say, if I waive this bond, will this decision be good for my long-term surety plan? What I really mean is, if this is a great job and it's going to be your new largest bonded job to date, because we had a little question about determining your maximum bond amount. If this is going to give you a new largest contract amount, you may want to go ahead and look at, do your self-assessment. Am I ready to bond this? If I'm ready to bond this, don't go with the waiver. And the reason you don't want to go with the waiver is because you cannot build a bond relationship with a bonding company if you are not needing bonds. Yep, that's how it really works. Get the news of your bondability out. Share the news. Let general contractors that you're interested in working with know. Let contracting officers, contract specialists, buyers, procurement professionals, hey, yeah, I'm a great business. I'm small business certified, and I'm bondable. Let small business liaisons know about what's happening at your business. All right, so we have some bonding. It may not be all the bonding that we want, but that's okay. We got some things that we're going to do to increase bond capacity. So when I mentioned that being really good at bonding may take 3 to 5 years, the reason it takes 3 to 5 years is because you actually got to get the bond, you got to do the construction work, you got to finish the job. If the job is 60 days, okay, that's moving pretty fast. But if the job is like 9 months, you got to actually be in the game, be in the bond game for 9 months, and that may be just your first bond, right? So it takes time. Things that you can do to increase your bond capacity. If you have a bank line of credit, when you have a bond line, you want to use your line of credit and your bond line, you want to use them wisely, okay? When you're trying to decide, do I take $1 million job? There's this opportunity, I love it, I want to pursue it. The estimate is $1 million and the schedule is maybe a year. But there's this other great opportunity that's $500,000 is the estimate, and the work is supposed to be over in 90 days. $1 million over in a year, or $500,000 in 90 days. Both, I went to the job walks, and I was one of 4 contractors. I can do this work. Well, when you're trying to decide which way to go, you got to use wisdom based on what it is you are trying to accomplish. If you are trying to turn over your bonding capacity to create more revenue in a year, the fast turning one will get that done for you. But if you are truly trying to increase your single bond limit, you may want to go after the larger project, because $1 million projects that are a good fit for small businesses, they do not come along every day. So when you see one and you have a real opportunity at it and you haven't bonded $1 million yet, you might want to move in that direction. As you were preparing to even be in that space, you were already working on those 3 C's, right? So you're ready. You can predict that you're ready. You're going to pursue and complete projects of increasing size and increasing complexity. This is a principle of bonding, okay? Bonding increases as you increase the size of projects that you do and the complexity of projects that you do. All of the Caltrans contractors that you guys know and love and that you go to mandatory pre-bid meetings to meet, they may be doing billion-dollar contracts or $500 million contracts. It didn't start out that way, okay? They had a certain amount of bonding, and then over time, they were doing projects of increasing size and increasing complexity, and the bond capacity kept growing. Back when I first started in the business, the biggest bond I'd ever seen was $250 million. These days, $1 billion bonds are being written. No comments about how long I've been around. All right, let's talk about building retained earnings. I know when you make a profit, if you leave it in the company, that's building retained earnings. That's also creating a tax obligation, right? If you've had great tax outcomes in prior years, then your net worth is probably not attractive to a bonding company today, right? But the key is to start to leave profits in there. We are midway the year, so you have time to make a business decision to determine how profits are going to remain in your company this year, okay? If you are trying to increase bond capacity, you want to let them remain in your business this year. So if you don't have a tax strategy or a construction CPA that understands the construction business and bonding, you need to find one. You need to interview them because you want to get a strategy to take care of your bonding and your taxes, and you want to get that strategy before you need it, okay? You want to improve your financial reporting. If you're only doing financials on an internal basis, like your internal accountant or accounting manager or bookkeeper, you want to connect that person to your independent CPA. If you don't have an independent CPA right now, you want to find one. Construction CPA that understands construction and bonding. You want to hire expertise. Now, of the 3 C's, character, capacity, capital, higher expertise goes in capacity. It's the capacity C. You want to get some great project managers, great superintendents, great controller, great accounting manager, great compliance officer, great HR, labor compliance person internally, right? But you also want to make sure you have the right expertise externally. Great surety agent. By great surety agent, someone that is a good fit for you, that knows the bond business. You may be able to get bonds from your insurance agent, and your insurance agent may even have a bond department. To truly get the insight you need, you want a surety agent that gets you but knows this business. Oh, yes. Expertise. It will help you increase your bond capacity. And then the most important thing I will probably say all morning, there's nobody in control of your bonding outcomes. I know it's tempting to think that the bonding industry is doing something to me. They're keeping me out of the game, or my bond agent doesn't like me, or is not responsive, or doesn't understand me. I'm poo-pooing all of that. The only superhero in your bond story is you, sir or ma'am. You are the bond superhero. How do you do that? You control it by making surety supportive business decisions all year long. I know. It's not like auto insurance comes up for renewal in May, so I'm going to start working on it in March. To be a surety superhero in your business, you're making decisions regarding character, capital, and capacity in January, again in February, maybe 2 or 3 times in March, April. You get the point, right? So whatever you are doing this year sets the foundation for your bond capacity next year. Okay? So make a strong foundation so you can stand firmly on it and know without a doubt, I got this. Miss Lorena, I'm ready for some more questions, I think.
Okay, Tracey, we have one question, and the person is asking if you can please again explain how to calculate the bonding capacity, and they ask for the working capital dollar ratio to bonding dollars. If you can repeat that, please.
Got it. Okay. To self-assess your bonding capacity using working capital, the formula, and this is from your balance sheet, okay? You're going to take the account current assets, total current assets. You're going to subtract total current liabilities. The difference between the two is working capital. In the example, $100,000 in total current assets minus, in the example, $50,000 of total current liabilities left a remaining amount of $50,000 in working capital. The general ratio, just general ratio in my industry, old bonding companies, new bonding companies, super traditional bonding companies, a little bit more flexible bonding companies, the general rule, $1 of adjusted working capital can hold up $10 of bonding. $10 of bonding. So we're talking 10%. So that $50,000 times 10 holds up $500,000 in bonding. Okay? And that $500,000 in bonding is an aggregate number. Okay? Of all the bonds you have in play at the time, $500,000 is supported by your $50,000 in working capital. Now, if you did that calculation and your current assets were $50,000 and your current liabilities were $100,000, you're negative, right? You have an issue. Okay? Those are the kinds of things that you're going to learn to identify right away yourself before you even send your financial statement anywhere. And you're going to say to yourself, what could I have done to make those numbers say something else about me? Liabilities come down when you pay your bills, right? They go down. Current assets, when cash is going out, current assets is going down, right? But if you're billing properly, accounts receivable is going up. The things that I'm talking about, just business decisions, right? Business decisions. Back to that last bullet, make surety supportive business decisions. That whole I'm a great contractor thing, you got that down. Managing your financial presentation, we can work on that. Ms. Lorena, is there anything else at this moment?
There's one more question.
Okay.
Okay, the question is it beneficial to have multiple bonding companies that you apply with?
Oh, I like this question. Okay, so bonding companies have different appetites. So for a construction company, the key is to find the right surety agent, right? So you get a surety agent that you like, and usually the surety agent will have 5, 10, or even 20, 30 bonding companies that they represent, okay? And then based on what the surety agent knows about the bonding company's appetite and quite frankly, the underwriter's skill set, right? Because underwriter's a real person, right? And if underwriter A, has taken a lot of accounts from me and approved them, but all of my accounts were road and highway, then all of a sudden I want to send that same underwriter a straight electrical contractor, it might be I take a little bit more to get that person on board, right? But if I have a bonding company that's really great with trade contractors as a surety agent, by experience, I kind of know what I have available. So from a construction contractor point of view, your job is to find the right agent. And then once you find the right agent, the agent will say to you, hey, okay, so I've looked at the information. I know where you want to go. This is our strategy. I am going to market or send your submission or send your application to 3 bonding companies or 2 bonding companies. And then the surety agent can explain to you why, okay? So you don't want to think that at the end of the day, you're going to write bonds with all 3, because you're not. Bonding companies absolutely don't allow that, all right? One of them is going to earn your business, and then that's the one that you want to build your surety relationship with. If you would like to talk about that more, you can send me an email later. Ms. Lorena?
We're good to go, Tracy. Thank you.
Thanks. All right. And we're almost to the end, so you guys hang on. Now, this slide, this slide's not really my cup of tea. But we're talking about unlocking revenue today, and I just got to go straight at it. What are the top 5 revenue barriers? No, it's not your bond agent. No, it's not your bonding company. No, it's not the bond requirement. The top 5 revenue barriers in the area of bonding are, number 1, a mindset against surety bonding. If you just love the idea that bonds should be waived, or that it's not fair, or it's discriminating against you, or I don't want to do it, that's one way you'll never make a dime in bonding. You will never make any money if you have, in the government construction arena, if you already have your mind set against surety bonding. Now, what else keeps you from making money with bonding? Believing there's a shortcut. There is no shortcut. I know, 3 to 5 years is a long time. Leaving money in the company for 3 to 5 years, bond lady? All those taxes, you're asking too much. You know what? I'm sorry. There is no shortcut. That's why the field of competition in government construction starts to shrink as the contract values get larger. And that's because business owners haven't wanted to do the things necessary so that they can play in the big space. What else keeps people from making money with bonds? Allowing someone else to manage a surety profile. I know. Contractors love to build stuff and see it, take shape. I get it. Paperwork sucks. I get that too. But nobody knows your story better. Nobody knows what you are wanting to do better. Nobody knows what risk or what you have at stake. From an indemnification standpoint, nobody knows it better than you. So when you turn your surety over to a general contractor, or you turn it over to your office manager, or you turn it over to a bonding assistance program, basically you're saying, I really don't want to make money at Surety. But we want to make money with Surety. So you have to manage it yourself. Number 4, when you ignore the business of construction. Being a great contractor, building it from the ground up, making the underground ready to put something fabulous on it, taking something that's ugly and in need of repair and making it beautiful. All of those things are fabulous about construction. But when it comes down to needing bonding so that you can qualify for government construction deals, you need to be about the business of construction. You need to be talking about risk, contract language. You need to be talking about receivables, collections, burn rates, all of these kinds of things. And everybody in your organization needs to be feeling that vibe. We're a great construction company. We build great stuff, but we are also a great business. Okay? And number 5, the 5th way to not have bonding that will make you money. Insist on financial reporting that is nothing like what I put on the sheet. Insist on staying with your QuickBooks, okay? Insist on having your cash basis statement. Insist on having your nephew who has a CPA but has never done construction accounting, insist on having him do your financial statement. These are the top 5 ways to not make money when you have bonding. You see it crashed, right? Bonding itself, the process, everything about it, Surety requires strategy, right? If you are just haphazardly going after it, hey, I need a bond, I went to the job walk, I like it, you're going to have some successes because some of the time it's just going to work out. But what about when you really need it to work out? Are you sure? Are you confident that all of the decisions that you've been making throughout the year, that all of the changes that you've been making in your character, capacity, and capital, are you confident that you have done what you need to do so that you can qualify for what you want? You got to have strategies to do that. You're going to have some short-term plans, and you're going to have some long-term plans. If you just got bonded this week, you want a short-term plan, start using my bonding right away. Example of a long-term plan, I got to get myself an independent CPA. I should start interviewing. If you're already bonded and you've been doing this for 5 years already, but you're still not quite confident in outcomes, short-term plan, have a meeting with my Surety agent and talk about where I want to be this time next year. Short-term plan. We're gonna have this meeting this week. I'm setting this webinar up right now. Long-term plan is, okay, I need to start to pursue projects that are increasing in size and increasing in complexity. So I'm going to alert my project management team to start looking for those types of projects. And we are going to look for those types of opportunities for the next 6 to 12 months. We are in it to win it. You're going to have plans in all 3 areas of the C's. You're going to have capital plans. I'm going to apply for a bank line. And for those of you that don't like debt, yeah, I get that too. But Tracey's tip for the day is just because you don't like debt, don't let that be a barrier for you getting the benefit of establishing a bank line. Establish it, use it a little bit. Bonding companies love that stuff. Underwriters love that stuff, okay? You're going to have a capacity plan, right? I know that I want to take my business into, say, the Arizona area. Or if I'm in Northern California, I want to start doing business in Southern California, right? Okay, so that issue of, and where have you done work, that's a capacity C, okay? So you want to have a plan to make that transition. Maybe your first couple of jobs in the new area, in the new geographic territory, are smaller. fast turning projects so that you can learn the lay of the land. Bonding companies love contractors that know when to say no. Yeah, because underwriters get paid to say no. So if you can say no to an opportunity yourself, or you can have a plan, like small projects, fast turning, to get me familiar with this geography, bonding companies love the fact that you are planning. Forecast your surety needs 6 to 18 months ahead. Most government agencies provide fabulous look ahead. Yeah, I mean, they tell you, what are things that they're going to be working on, what things they've already submitted for legislative funding. And if you can see it, you can plan for it. There's no reason why a project that's coming up 18 months from now, and we know it today, that we can't be ready. What? Of course we can be ready. We know what we can do to get ready. We're going to make some adjustments, and we're going to make these adjustments to our surety profile continually, every day, all the time in our business decisions. Surety bonding is like nothing else out there. I mean, in all honesty, my parents don't even know what I do for a living. That's how weird it is. But once you actually master this part of your business, you are going to be amazing. My tip for bonding success, and that's tip, TIP. If you manage timing, apply insight, and increase your preparedness, your bonding experience will be almost stress-free. And if you've already kind of done bonding by trial and error, that the idea of stress-free bonding just sounds like a pie in the sky. It's not. Timing. Make the right decisions at the right moment so you'll have what you need when you need it. Apply insight. The things that are in this PowerPoint, work on them. And then look at them again 6 months from now and work on them some more. And then look at them 12 months from now and work on it some more. And then increase your preparedness. Be prepared to be evaluated by your bonding company. Know that you're ready. Ms. Lorena, are there any questions?
Tracey, no more questions at this time.
All right. Okay, I take that to mean that you guys get the hang of this thing and you're going to be amazing. I cannot wait to hear your success stories when you're sending your emails to your small business liaisons in your different Caltrans districts. Hey, send a girl up, put me on the CC so I can be like clapping for you. Make a lot of money, create a lot of jobs, and make a difference in your community. Thanks for listening.
Thank you, Tracey. That was a wonderful presentation, so much useful information. I think we're all learning a lot about bonding. So now at this time, I'm going to introduce our new presenter. So we have a representative from Teichert Construction, Sean Collins. Sean is the Credit and Contracts Manager for the Teichert Group of Companies. Teichert is a 133-year-old construction and material supply company based in Sacramento, California. It holds California State Contractors License number 8, which is the oldest active license in California. Sean is the 6th generation native from Northern California. He's been with Teichert for 27 years in various treasury, credit, and risk management functions, and is currently responsible for corporate credit, contracts, financial risk management, and bonding policy corporation-wide. Sean, whenever you're ready.
Thank you. I appreciate that, Lorna. Can everybody hear me okay?
Yes, we can hear you.
Perfect. So one thing I noticed about that photo is that was definitely a pre-COVID photo, because what you guys have to stare at now is the longer hair, the longer beard, and a bunch of gray hair from, I'm just going to blame COVID on that one. So good morning. Appreciate everybody's time. So that presentation Tracey gave was absolutely wonderful. what I'm going to talk about now is from a general contractor's perspective. What does bonding mean? And perfectly simple, it's the lifeblood of all contracting. So I think a lot of folks might be interested in Caltrans or Public Works, but I'm here to tell you that bonding drives growth and efficiency on the contracting side, no matter what type of work you do. So I'm going to talk a little bit about why is bonding important to a general contractor and how do we use bonds. And we use bonds both uphill and downhill, and I'll explain that. But really, there's kind of three major ways, right? Which is I'm going to talk about one, how bonds are the lifeblood of contracting. I'm going to talk about how we use bonding in partner selection and how we use bonding for risk management. Those are kind of the three big ones. So like Lorraine had mentioned, Teichert's 133 years old. We've been doing public works since the 1800s. And we know that in California, all general contractors are required to post bonds to both bid and perform public works. Those bonds are there to protect the taxpayer from costs, for price overruns, failures, claims, things like that. So we have to have bonding capacity. So even a company the size of Teichert still works with their surety every month and every year, and we go over our WIP schedules and our financials, and we talk about job performance and the next biggest job we're going to have. It's all relative. So, but also just be aware that there's a lot of private work that requires bonds, and there's a lot of private work and public work where the general contractor is going to require bonds from their subcontractors. So bonds are applicable a lot of places. Well, let's talk about what does a bond mean from a contractor. Tracey talked a lot about the surety side, but what a bond means for a contractor is a bond is a guarantee. It is a third party guaranteeing that we will do what we said we were going to do. We will perform the work according to the schedule and according to the estimated amount, and we will pay our bills according to the contract. That's what a guarantee is. So as a general contractor, every public works job that we bid, we have to guarantee to the state of California that we will do those things. So what does that mean? If Teichert's bidding, let's say it's a $100 million project, and we're going to subcontract out $25 million of that. We're a savvy GC. We're going to ask that the subcontractors performing that work, they bond their $25 million worth of work to mitigate against the risk that we don't necessarily control because others are performing that work. So that's a major thing that we do, and everybody should be aware that general contractors, when they require bonds from subcontractors, are almost always willing to pay the reasonable bond premium for the cost of those bonds. So once you obtain bonding capacity, don't be worried about the cost of obtaining a bond, because if it's a reasonable bond premium, most general contractors are going to be agreeable to paying for that as a risk management fee as part of your total cost that you charge to the general contractor. So hopefully that makes sense. So I'm going to talk a little bit about how general contractors use bonding for partner selection. And so most general contractors are going to have some sort of a pre-qualification process in selecting their partners, like their subcontractors. And that can be a very hard process, or it can be a very easy process from the general contractor's perspective. And so for us, the hard way to go would be to ask every subcontractor to pre-qualify. Well, what would that involve? That would involve everything Tracey mentioned that you should already be doing with your surety. So if you cannot bond, we may ask you to provide financial statements, WIP statements, cash, talk about your bank lines, talk about your WIP schedule, talk about your resumes, talk about your history. Do you as a subcontractor, do you want to do that every time you work with a new general contractor? I would argue probably not. But on the other hand, if you can bring a bond, that means that someone else has already instantly pre-qualified you. There is a third-party national surety that has backed you up and said that they've already looked at your character, your capacity, your capital, done the underwriting on you and said, I will back them up by guaranteeing their work with a bond. If I, as a general contractor, get one of those, I have no need to do any other pre-qualification process. right? So do you want to have to do that every time you talk to a GC, or would you rather already have bonding capacity, be able to present that and go? So I can tell you general contractors are much more likely to take on a brand new subcontractor or a perceived unknown subcontractor or a perceived risky subcontractor with a bond, much more so likely than one without a bond. I can also tell you, and I see this quite often, our estimators are more likely to choose a non-low price subcontractor with a bond over a lower price subcontractor without a bond. And that's because of what large companies like general contractors do to mitigate their risk. And so for us on a $100 million project, if we're going to be awarding a $200,000 subcontract and the difference between low and number two was $20,000 on $200,000, the $20,000 high contractor can bond and the one that's $20,000 lower cannot, we're going to go with the bonded higher subcontractor almost every single time because it's a risk factor for us. So keep that in mind when it comes to your bonding capacity and working for general contractors. So kind of the last little piece is why do we do that? Why do general contractors do that? Well, it's the company-wide risk management philosophy. It's how larger companies manage their risk. And so risk, the number one way that general contractors manage risk is through bonds and requiring bonds from subcontractors. So I'll give you an example. My company has a blanket policy that all on-site labor subcontracts over $100,000 in value require bonding regardless of whether it's for a public works job or a private work job. So it's not just so that if new subcontractors would like to do work with someone like us, it's not just that they need bonding to work for us on the public side. We also require bonding on the private side. So bonding is the lifeblood. And again, why? Because there's a third-party surety that's guaranteed your performance. And as you all know, people are trading bid numbers with each other at 10 minutes to bid time, and sometimes we'll get a number and it'll be from a subcontractor we don't know. So we don't know them and we don't know their ability to perform the work. And we see that they're a little bit lower than everybody else, but they cannot provide a bond. That makes it a very risky discussion for us at 10 minutes to bid time as to whether we list that subcontractor or not, versus I don't know this company, but they've got a bond from a reputable surety. We'll take that bond every day. So that guarantee of having some other surety bonding, guaranteeing the work, helps us mitigate our risk. So the two types of bonds that are typically issued that we ask for from our subcontractors are payment bonds and performance bonds. When you go to your surety, you're going to get those together as a package. So if your subcontract is worth $400,000, you're going to ask for and be issued payment and performance bonds for $400,000. So let's go over both of those really quickly. Why do we want a performance bond as a general contractor? Because someone else is guaranteeing that the subcontractor will complete the job at the bid amount, and scheduling comes into an issue. But it's that they have the capacity to finish the work, and if a subcontractor cannot finish the work, the surety will ensure that the work is finished. So imagine how that helps a general contractor manage risk. Secondly, and a little less probably commonly known, are for the payment bonds and what that allows a general contractor, how that allows us to manage our risk. Payment bonds are a guarantee that a subcontractor will pay all of their bills for their subcontractors and suppliers, and therefore that helps mitigate against any claims, because a general contractor can have claims go against it for the lack of payment sub-tier to their subcontractors. And so on private work, you can have mechanics liens against your project. On public work, you can have stop notices that freeze your funds. So those payment bonds help with that. The second and becoming more important than the one I just spoke about on payment bonds is payment bonds cover labor compliance and ensure that everybody sub-tier to a general contractor pays their wages, pays their benefits, pays their union trusts, all the way up and down the food chain. And in California, labor compliance just gets more and more complicated every year. And we see more and more claims that come from somebody 4 tiers down that we didn't know or know about. And according to California law recently, general contractors are inevitably responsible for all unpaid wages, fringes, union trust benefits, meal break penalties, the whole 9 yards on any project that we're on. So that's why the payment performance bonds are so big for us and why most general contractors are going to require them on work. Another thing to know about bonds is in California Public Works, in California, most public works projects hold 5% retention on the general contractor. And in most Caltrans projects, there's no retention held. Public contracting code allows that the general contractor, we can actually hold more retention on our subs than is held on us by the owner if at bid time and our bid solicitations bonds were required and the subcontractor said they could provide it. And then all of a sudden they said, I'm sorry, I cannot provide it. Can you waive the bond? In those cases, I make a risk management decision and sometimes I choose to waive the bond, but we might hold 10 or 15% retention. So having bonding capacity could actually free up your cash flow or increase your cash flow or preserve your cash flow. And one of the very last things from a risk management perspective that helps everybody as general contractors, many general contractors, ourselves included, if we have bonded subcontractors, we may not require some of the extra paperwork that's required on construction projects every single month, like lien releases, verification of union trust payments, labor wage affidavits, things like that. If there's no bonds, we're probably going to ask for all of that additional paperwork every single month prior to cutting your payment loose. But if you have a bond, we might only ask for those things at the very end of a project. So those are kind of, that's how a general contractor looks at their bonding relationship, both uphill and downhill. Uphill, it's the lifeblood to continuing to work, and downhill, it's most large general contractors are going to require bonds from their subcontractors to help with risk mitigation, and there's pros and cons to that. So with that's all I had. Kind of give you a quick overview of why and how bonds are important for general contractors, and if anybody has any questions, I'd be glad to answer them.
Hi, Sean. Yes, we have a couple of questions. So here's the first one. What is your typical timeline and experience going after a particular bond from a subcontractor?
Might ask for a little more detail on that one. If you could ask, what does it mean by going after? Are you talking about obtaining a bond after we've listed a subcontractor?
Hey, Sean, this is Peter Hendricks. I'm a district permit engineer down here in San Luis Obispo, and there's been a few occasions where I've had to go after a bond because of a failure of either work quality or payment. And so when I did that, I just started getting calls from very curious people associated with their bonding. Maybe it wasn't the surety company, but it was some kind of shadow investor. And it was very intriguing to be involved in that, to be getting all these phone calls from different people. Also, the surety company was just very difficult to deal with. I didn't end up getting any money for the state. And it was just kind of let to languish. But I was wondering if you could maybe explain your experience in trying to make a claim on a bond.
So I can tell you that I've been successful on payment bond claims 99% of the time. You have, as a contractor, when you indemnify the surety and pledge your assets, and they in turn guarantee you, it's very hard for the surety to push back against payment bond claims because they're usually pretty cut and dry. Did you or did you not pay your wages? Did you or did you not pay that supplier who has lien rights? So from the payment bond claim side, that's the number one strategy for protecting our rights. And I can also tell you that my company has significant material supply corporations where we chase payment bonds when contractors fail to pay us for materials that they purchased. And like I said, we're successful 99% of the time. Performance claims against a bond are a little more complicated, and those usually go back to the strength of the contracting documents and the schedules and the liquidated damages clauses and things like that. But typically, we've had good success in defaulting subcontractors as long as everything's in the contract and a general contractor performs above board when it comes to defaulting a subcontractor and taking the claim up with the surety. I've had very good success when subcontractors have filed bankruptcy, and we've had to get the surety involved and ask them to either pay or contract someone else to finish a project for us. Those are big, complicated scenarios with a lot of moving parts to it, but you have to have experience in that piece. But I think the moral for everybody on this story is to know that, and I think Tracey mentioned this early on, the bonds do not protect you. The bonds protect the people that you issue the bonds to, the agencies, the general contractors, and in most cases, those sureties will stand behind their guarantee and make the agency or the contractors whole. That's my experience anyway.
Thank you, Sean. We have one more question. Okay, so as a subcontractor, should we include our ability to bond in our proposals?
Absolutely. Absolutely. That if you have bonding capacity, that's absolutely, general contractors need to know that. Their estimating teams need to know that, because you might not know who you're working with. You might be seeing that there's 10 general contractors bidding a project and you'd like to have a piece of the subcontracting work on that project, and you don't know what their corporate policies are. And I'll be honest with you, not all general contractors require subcontractors to bond. It's very, very different depending on different markets and things. I can tell you the Central Valley of California is very different from the San Francisco Valley versus the Los Angeles area. And so you don't know who you're dealing with. And like I told you earlier, you might not know that Teichert Construction tells its estimators you have to require bonds over $100,000, or there's a significant process that estimators have to go through to utilize an unbonded subcontractor. And so if you have bond capacity, this goes to Tracey's presentation, you want to share that with the world because you have someone guaranteeing you. And two is always better than one when it comes to risk and performance mitigation, right? That I might not know you really well, and you might try to convince me in the 5 minutes before the bid is due that you can perform the work. But if you've showed me a bond, that meant that over the last 2 to 5 years, you've convinced your surety of greater success that they can guarantee your performance. And in a fast decision, like needing to make bid decisions on public works projects 10 minutes before bid time, that's usually a deciding factor on most estimators that I know.
So it looks like those are all the questions we have for now. And we have a couple of minutes. Does anyone else have a question for Tracey or Sean? No questions, but people are saying great information, and thank you. Okay, thank you, Sean. Thank you, Tracey. Wonderful presentations. Thank you for all the valuable information shared today with our participants. Thank you for everyone else for joining us today. And also to our participants, before you leave, please submit your full name and email to the chat so we know who was here today. We had some participants joining us via phone call, so we want to get your information. Again, we really appreciate your time, and we thank you for joining us in this webinar.
And on behalf of Caltrans District 10 and District 5, 6, and 9, we want to thank you for all coming to this today. I want to thank our partners, Teichert Construction, Sean Collins, for your time, Tracey Lawrence, the Heis Surety. Thank you so much for your expertise, both of you. And if you have any other questions, please feel free to contact me, Bob Adams at Caltrans. My email address is bob.adams@dot.ca.gov. I will be emailing this presentation out after this webinar, and it should be hitting your inboxes. If you don't receive it, just send me an email and I'll be happy to send it out to you. With that, we'll go ahead and close for today, and I thank you very much for your time and good luck in contracting. Thanks, everybody.
Thank you.